Alright, today is June 6th. I'm going to look at trading the natural gas storage out of the US. Comes out at 10:30. Time is now 10:21. So we have a little bit of time here. I'm not going to be using JOBB for this particular release. I'm going to be testing out a new way to trade natural gas. I've been testing it the last couple weeks. I haven't put it on the blog, but just for my own personal records, and it has been doing fairly well. So with that being said, I'm going to give a brief explanation, and then hopefully you guys will understand what I'm doing as the release comes out. Alright, basically what I'm going to do is 29 at the 29 bar, I'm going to look and see where the larger institutions have most likely placed their money, because from what I believe to have seen in the past is they get the news earlier. I'm not sure how much earlier they get the news, but I'm pretty certain that they do. And one thing I'd like to take note of now is the fact that we've had these short sales right here, several of them actually, and the market has been overall in a downward movement. So that tells me, at least at this point, that they've placed their orders and they're waiting for the news to come out, and that they know something that I don't. But I'm going to wait until this says 10:29, because obviously it is possible that the market will start shooting up in this amount of time, but we'll have to wait and see if that happens or not. Now at the 10:29 mark, I'm going to decide whether or not I think the larger institutions are betting on a long or betting on a short. And whichever direction I think, I'm going to, for example, if I think it's going to go short, which I do right now, I'll enter a sell bid. If I think it's going to go long, I'll enter a buy on the ask. Now, for this example, let's say I'm going to do a sell bid. Once I enter that, that means I'm in the market. And once I'm in the market, that means if we do get a short, there's going to be zero slippage. I'm just going to be good. You know, if it goes 60 pips, or excuse me, not, this isn't Forex, but if it goes 60 ticks, then I will basically have 60 ticks in profit without the 30 ticks in slippage. But on the other hand, let's say it turns out negative, it turns out bad. What I'm going to do to counter that is come above, say about right here, and I'm going to go ahead and enter buy in the stop.
Order pending.
Well, that's not good. That actually moved really slow. And then another buy in
Order
the stop.
pending.
Okay. Now the reason I entered two, alright, is because my main entry, which was a sell in the bid, had one contract. So if the market doesn't go down, then that means it's going to shoot up. And if it shoots up, this first one right here is going to cancel my original sell on the bid, and this second one here is going to enter me into a buy. I hope that makes sense. So basically there's a 50-50 chance that, you know, the market is going to go short, and I'm trying to increase my odds by looking at where the big money is placing their orders, and that's pretty much all it is to it. One way is going to be zero slippage. The other way, I won't make as much money, but it's still highly probable that I'll be able to make some money. Okay, so that's the idea behind it, and I will be back with you guys shortly, and we'll see how this little test works out. Alright, I'm back now. As you can see here, I'm going to go ahead and enter my sell on the bid.
Order pending.
And it has,
order filled.
For some reason it's just moving very slow right now, and it actually just froze, excuse me. So what I'm going to do now is place this here, buying a stop,
Order pending.
and a second one right here, buying a stop.
Order pending.
Now we'll see what happens here. We have about what is it, 10 seconds to go. If we get a spike before 10:30, I'm going to exit immediately. The spike happens after.
Order cancelled.
Alright, now as you can see here, we pretty much caught that entire move with zero slippage. And if the market would have, well, not the market, if we would have had a up spike, we would have got out on one of those buy on the sell orders, or buy and a sell, buy and a stop, I believe it was. We would have got out on one of the buy and a stop orders, and we would have been entered long on the other buy and a stop order. And again, there was a 50-50 chance, and we just kind of helped our odds by trying to figure out where the larger institutions that might actually know something ahead of time have put their money, in which direction they put their money rather. Anyway, this is the third time I've tried this, and so far it's done well. I've had one occasion where the market, I think it was 1029.54, and the market spiked up, and it stayed up for about 5 seconds, and you just have to exit once you basically get filled, if the spike happens before 10:30, because if you wait until it hits 10:30, there's a good chance the market could reverse on you. Alright, so that's the best advice I can give on that. You guys can test it yourselves. The idea seems sound. You're in the market early. If it goes in the direction you expect it to, you make a lot more money. If it goes in the direction that you didn't expect it to, then you're still either come out at break even, or you might even make some money. When I did it last time, I was still able to make money when it went in the opposite direction. Anyway, this video is running a little long now, so I'm going to go ahead and shut it there. Thank you.